Hello and welcome to Dividend-Play US. Are you looking for a way to earn consistent, high-yield monthly income, but you also want to stay invested in the exciting, high-growth world of technology? It can often feel like you have to choose one or the other, high growth or high income. But what if there was a way to combine them? Today, we're doing a deep dive into a very interesting investment vehicle that aims to do just that. It's the BlackRock Science and Technology Trust, ticker symbol BST. It boasts a dividend yield that has historically been in the 7 to 9% range, paid out monthly, all while holding some of the biggest names in the technology sector. Stick around as we break down exactly what BST is, what's inside it, its performance, the pros and cons, and who this investment might be perfect for. Before we dive into the details, a quick but very important disclaimer. This video and everything on this channel is for informational and educational purposes only. I'm sharing my personal research and opinions to help you learn, but this should not be considered as financial or investment advice. The market is complex and everyone's situation is unique. All right, let's get into the fundamentals. What exactly is BST? As you can see here, BST is a closed-end fund, or CEF. This is different from a typical mutual fund or ETF. A CEF has a fixed number of shares that trade on an exchange, just like a stock. This means its market price can be different from its underlying value, which we'll discuss later. BST was established back on October 29, 2014. The fund manager is a name you've almost certainly heard of, BlackRock. They are the world's largest asset management firm, which brings a significant level of trust, resources, and expertise to the table. Now, for the investment policy, BST invests in the global science and technology sector. It's not just holding a broad index, it focuses on what it considers to be leading companies with a high degree of innovation. This leads to its objective, to generate total return. This is key. They aren't just aiming for stock price growth. They want a combination of current income, current gains, and long-term growth. So how do they generate that high income? That's where the key strategy comes in. BST utilizes a covered call strategy. Let me break that down. They own the stocks, like Apple or Microsoft, and then they sell call options on those stocks. Think of it like renting out the potential upside of your stocks in exchange for an immediate cash premium. This premium is what helps fund those high monthly distributions. It's a strategy designed to generate cash flow. And speaking of distributions, the fund pays a monthly dividend with an approximate yield historically around 7 to 9%. Finally, the expense ratio is 1.07%. This is the annual fee you pay for BlackRock to actively manage the fund, run the option strategy, and cover operating costs. It's higher than a passive ETF, but typical for an actively managed fund with a complex strategy like this. So when you buy a share of BST, what are you actually owning? Let's look under the hood. This slide shows the top 10 holdings, which make up a significant 52.34% of the entire fund. This tells us the fund is quite concentrated in its top picks. And these are the giants of the tech world. NVIDIA is the largest holding by a wide margin at over 13%, followed by Microsoft, Broadcom, Apple, and Meta platforms. You'll also see some other familiar names like Oracle and Amazon. What's particularly interesting about CEFs like BST is that they can also hold private companies. You can see holdings like Project Debussy and Anduril Industries, which you typically wouldn't get access to in a standard ETF. If we look at the sector breakdown on the left, it confirms what the holdings suggest. The fund is heavily weighted towards software and services and semiconductors, which together make up over 60% of the portfolio. This is a pure play bet on the core drivers of the technology industry. This next slide is crucial for understanding how to value a closed-end fund like BST. We're looking at its price versus its NAV. First, what's NAV? NAV stands for Net Asset Value. It's the true underlying value of all the stocks in the fund's portfolio calculated on a per-share basis. The price, on the other hand, is simply what the fund is trading for on the stock market, driven by supply and demand. Because CEFs have a fixed number of shares, the price can trade higher than the NAV. That's called a premium, or lower than the NAV, which is called a discount. Looking at the table on the right, you can see that BST is trading at a discount of negative 6.27%. This means you're buying a share on the market for $39.99, but the actual underlying assets for that share are worth $41.60. Essentially, you're buying that basket of incredible tech stocks for less than its market value. For many investors, buying at a discount is a major draw for CEFs, as it can potentially boost your total return. The long-term chart on the left shows how this relationship between price and NAV has fluctuated over the fund's history. This slide perfectly illustrates the story of BST and the power of its dividends. On the left, we have the price return since 2014. This chart shows only the change in the stock price itself. It's up about 96%, which is a respectable performance. But now look at the chart on the right. This is the total return. This includes the price change plus all of those high monthly distributions, assuming they were reinvested. The total return is over 325%. The enormous gap between these two charts, from 96% to 325%, is the income component at work. It shows that a huge part of the long-term return from BST doesn't come from the stock price going up, but from the steady stream of cash it pays out to investors. This is the covered call strategy in action. Let's dig a little deeper into the performance numbers. The top chart shows the average return over various timeframes. The 10-year average return is a very strong 16.58% annually, which is fantastic long-term performance. However, the table at the bottom, showing average return each year, tells a more complete story. It highlights the volatility of the tech sector. Look at 2020, an incredible year with a nearly 70% return. But then, fast forward to 2022, when the tech sector faced a major downturn and the fund dropped almost 40%. Then it bounced back strongly in 2023. This shows that while BST is designed to provide smoother income, the underlying value of the fund is still very much tied to the ups and downs of the technology market. It's not immune to market corrections. Now, for the main event for many income investors, the dividend. The current annual dividend is $3 per share, which, based on the price as of 29 July 2025, gives it a yield of 7.72%. The table on the left shows the dividend history for the past year. As you can see, it has been very consistent, paying out $0.250 every single month. This reliability is exactly what passive income investors are looking for. The chart on the right shows the dividend history since the fund's inception in 2014. You can see that steady base of monthly payments, but I want to draw your attention to something else: the large spikes. These are special dividends. In particularly profitable years like 2019 and 2021, on top of the regular monthly payments, the fund distributed its excess profits back to shareholders in the form of a large, one-time special dividend. This is a potential bonus that can significantly boost your annual income in good years. So, let's put it all together and summarize the investment case with the pros and cons. First, the pros. High monthly dividend. This is the primary appeal. A consistent 7 to 9% average yield paid monthly is fantastic for generating passive income. Investment in technology. You get exposure to the high growth potential of innovative global tech leaders. Managed by BlackRock. Having the world's largest asset manager behind the wheel provides a layer of trust and professional management. Potential discount to NAV. The opportunity to buy a dollar's worth of assets for less than $1 is a compelling value proposition. Now for the cons and risks, which are just as important. The covered call strategy. This is the big trade-off. While it generates income, it caps your upside potential. If Nvidia stock doubles in a year, BST will not capture all of that gain because it sold a call option. You are trading away explosive upside for more certain, immediate income. Sector concentration risk.
This fund is a concentrated bet on technology. If the entire tech industry faces headwinds, like it did in 2022, this fund will be heavily impacted. There isn't much diversification outside of this sector. Return of capital risk. This is a subtle but important risk with high-yield funds. Sometimes, if the fund's earnings don't cover the dividend, it might pay you from its original capital, essentially giving you your own money back. This is called return of capital, or ROC. If this happens consistently, it can erode the fund's NAV over time. It's something investors need to monitor. So with all that in mind, who is BST really for, and what role could it play in a portfolio? Let's look at the portfolio type table first. In an income or retirement portfolio, BST could act as a key midfielder. It generates that consistent income you need while still giving you a foothold in the growth-oriented tech sector. In a balanced portfolio, it could be a substitute or supplement. It can help reduce overall portfolio volatility by providing a steady income stream while you wait for other stocks to perform. And in a pure growth portfolio, BST could be seen as the main star for cash flow. It's the primary engine that turns your growth-focused assets into spendable cash. Looking at the investor profiles below, it's a great fit for hybrid investors who want both growth and income. It's ideal for retirement-focused investors looking to create a monthly income stream, and for investors with a high risk tolerance who already own tech stocks. It can be a tool to generate supplemental income from that portfolio. However, for risk-averse investors, this is likely not the primary choice due to its concentration in the volatile tech sector. So, to wrap it all up, BST is an excellent and powerful investment tool for a very specific job: creating cash flow from growth stocks. It masterfully transforms the long-term growth potential of the technology sector into tangible monthly income. But this benefit comes at the cost of not achieving the highest possible returns that you would get from holding the tech stocks directly, especially in a strongly rising market. It's a classic trade-off between maximizing income and maximizing growth.
Thank you so much for joining me for this deep dive into BST. I hope you found it clear and helpful. If you did, please consider hitting the like button and subscribing to @Dividend-Play US for more analysis on income-generating investments. Thanks again for watching, and I'll see you in the next video.